Welcome to Stock Watch with me, Ndauleng Lechela, and joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Jean Pierre Verster from Protea Capital Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag StockWatch. Grant, JP, thanks so much for your time today. Now, I feel like we're going through another phase of deja vu where sentiment is downbeat at the top of the week, but I'm sure it's nothing to worry about, right? Just some jitters, just some profit taking place ahead of the Fed meeting, Grant.
Yeah, definitely, darling, that's what I'm seeing here. I mean, look at the year we've had. It would be silly not. This is the kind of time of year where people look at their portfolios, maybe take a little bit of money off the table, bank some profits. It's been a great year if you've been invested in most things, not everything, but most things. And I'm not like, there's no fundamental downshift in any of the economic data, whether it's the US. If you look at the consumer, a lot of the numbers are still robust under the surface. In SA, things are moving in the right direction, improving. And it may be a bit of buy the rumor, sell the fact with the Fed, but on balance, I would say there's enough in place to say there's not a structural shift. Any selling now, any profit taking is more like a consolidation than something's changing. So I still think there's a lot of opportunity out there, and if there are pullbacks, we will be looking to buy some of the dips.
And talking about taking some profit, I'm sure some investors are just taking some profit to go spend on, a holiday, a Christmas holiday of some sorts, right, JP?
Must be in Ndauleng. I mean, all of us have worked very, very hard. So I think we're allowed to spend some money over the festive season. And yes, if your dividends weren't enough, then you might need to dip into capital and therefore sell some shares. Just keep in mind your tax consequences. And that is why I always prefer to invest in unit trusts and collective investment schemes from the retail market. People like Grant and our companies offer funds which are tax efficient, and if we trade within those funds, it doesn't lead to a nasty tax bill for the ultimate investor. So something to keep in mind over the festive season.
All right, let's get into that Fed meeting taking place tomorrow. What will you be looking out for? Their bets, of course, are for a cut. I think markets are already pricing in 90% at this point. Chances are high. What will be interesting, though, I'm sure, will be the commentary around economic prospects, especially as we wait in anticipation for Trump's announcement on who will be the Fed's next chair, Grant.
Yeah, I mean, I think it's so much more than just whether they cut or not. Yeah, a lot of 90% cut in the price. But what is it? A dovish cut, a hawkish cut? Is there more to come or less to come? The market is still expecting at least another 2 cuts next year. There were 3 priced in as a majority probability only a short while ago. Now it's down to 2. Does he bring in a neutral or someone that's in his pocket? It looks like the favorite is more of a neutral, will be a little more independent than Moran, for example. So that's a good thing. And I think, how do they play this trade-off between the jobs data? We can see the job numbers slowing. We can see inflation still sticky. They've got a tough job. What are they going to talk about? And of course, Powell is nearing the end of his term, so he's becoming less and less of a factor. And really, it's about who comes in next and what kind of sway do they hold with the rest of the board. So there's a lot to dissect from this update, and not much of it is whether they cut 25 bips or not. It's around what kind of cut it is.
And what's also stealing headlines today is that Warner Bros. Sale, right? So Netflix seemed to come out tops there, but yesterday Paramount coming through with a hostile takeover bid. Just your thoughts on what's playing out there, JP?
Very interesting. So I think the first thing is there's all kinds of anti-competition concerns, whether it's Netflix that's allowed to buy Warner Brothers Discovery, or whether it is the Paramount group, the combination of Paramount and Skydance that buys Warner Brothers. So either way, the politicians are going to get involved. A regulator is going to get involved. And in the US, the regulatory space has become very politicized. So you obviously have Jared Kushner and a few friends of Trump on the side of Paramount, which has now launched the hostile offer. which means they'll go directly to shareholders. The shareholders must decide if they want to accept the offer. While the Warner Brothers board is more in favor of the Netflix offer, because it means that the CEO, Mr. Zaslav, will keep his job within Netflix in the division of Warner Brothers. So it's going to be an interesting one. I think whenever you have a fight like this, the best way is to own the shares of the target, of Warner Brothers in this case. Although either way, whichever one of these two parties win, there's going to be some issues.
Yeah.
Either some competition, regulatory issues, if it is Netflix, or a big break fee that's payable to Netflix in terms of that agreement that the board signed with Netflix, if Paramount is successful with their counterbid. So it's fascinating to see. And for South Africans, it probably means it's going to become even more difficult for DStv to get all the different channels that they want on their own bouquets, because maybe some of these channels like HBO might find its way to Netflix, and that'll mean people are going to scratch their heads if they really want to pay the DStv subscription, which might become an important question when Canal Plus lists on the JSE next year. It's probably quite negative for Canal Plus, this whole merger.
And let's get your thoughts around that. JP mentioning all those risks at play. Who would you be holding at the moment? The likes of a Netflix or even the likes of a Warner Bros?
Well, I think if you hold Warner Bros, you've done well, but I would be looking at moving toward the door on this counterbid from Paramount, because there is a real chance that something gets blocked here. As JP said, there's a lot of competition concerns. Trump is known to be family friends with the Paramount related parties.
Yeah.
So they'll push hard against Netflix. And quite frankly, I do think the Netflix acquisition will provide almost a monopolistic position, or certainly, I don't think it'll be in the best interests of the consumer. I think jobs will be lost. But I think as a consumer, they'll do an amazing job, and as a shareholder, with the franchise that Warner Brothers has, an amazing catalog of titles and names that I think would be fantastic in the Netflix stable, but I don't think it'll be good for consumers. So I think if, the company I like most here is Netflix from a core perspective, from a quality business perspective.
Yeah.
If I held Warner Brothers, I'd probably look at taking some profit. Paramount, I don't have a strong view on. So that's where I am on that.
I want us to move over to what's playing out in Nvidia, and on the back of, us speaking about Trump recently announcing that Nvidia can sell its H200 chips in China. So this chip better than the H20, but not necessarily the highest end of chips from Nvidia. In addition, the US wants 25% cut in revenue. What do you make of that? That's from 15% to 25% now, Grant.
Oh, look, it's a big number, but remember, Nvidia's running at 75% or so GP margin and 60% operating margin, so they can afford it. And rather they take something of something than everything of nothing. So I don't think they're in a position to argue if they want to participate in the sales to China. The door's closing anyway. In a couple of years, China won't even be wanting their chips. The H200 is 12 to 18 months behind the Blackwell. So it's not even the latest.
Yeah.
It's really a question of capacity. Where do they find the extra capacity to sell to the Chinese demand? As we understand it, there's still a shortage of supply across all these cutting-edge NVIDIA chips. So I'd be interested to see how that plays out. But I think they'll pay the price because, again, rather take something of something than everything of nothing.
And then I want to ask you, JP, how important the Chinese market is to NVIDIA at the moment, considering those export restrictions at play. At the same time, Grant also mentioning there, China moving with intention to develop its own chip ecosystem.
Exactly. So it has become a decreasing part of how important it has been for Netflix, for NVIDIA directly. But indirectly, there's been a lot of discussion whether some countries that are importing NVIDIA chips, like Singapore, for instance, are just a reshipping destination for the chips to find their way into China in any case. So on a ultimate buyer perspective, China is very important. You've seen a lot of announcements that they make regarding the developments they've had with their own LLM models being very efficient, being very powerful. And to train those models, you do need these GPU chips. So these chips have found their way into China. They'll continue to find their way into China, whether directly or indirectly. But I agree with Grant. I think in a few years' time, China is developing their own chip sector very quickly, spending enormous amounts of money. So they might not really need the Nvidia chips as much. The reliance might really break down. And a lot of other companies, whether it's US companies or international companies and Chinese companies, are developing competitors to Nvidia's chips. So it's a fascinating area. And because it's got so much excitement, the valuations are quite high. So Nvidia and a lot of these other companies in this ecosystem can't put their foot wrong. Otherwise, you could see quite a steep correction in their share prices.
And just staying with you, JP, a question here, particularly for you. And I think we did speak about this last week, but I guess coming through again, is Blue a long or short? And why would the outcome here be different to Optasia?
So Blue is a different company to Optasia.
Yeah.
I mean, Optasia focuses on effectively making loans to cell phone clients, whether for airtime or for small business or personal type loans. Blue, after the unbundling of Cell C, still has significant exposure to Cell C. So if you buy Blue shares, you're still getting Cell C exposure. And then the rest, they do have the Easy Pay type businesses. Easy Pay is in Lusaka, but they've got their own payment businesses. We can buy airtime, you can buy electricity, and those businesses are very cash generative, not quite as high growth as some of the competitors are. So Blue on its own is a decent business, but you're still getting Cell C indirect exposure.
Yeah.
Personally, even though they've sold a big chunk of Cell C, I don't like the indirect Cell C exposure. So I'm staying on the sidelines when it comes to Blue.
Grant, what are your prospects in the logistics sector? And is Grindrod one of the options to nibble on? And is the Baltic Dry Index still to be considered?
Interesting. So I think Grindrod is a good business, and I think they've done a good job over the past few years of repositioning and capitalizing on Transnet's sort of weaknesses, if you want to call it that, as stuff has been diverted through Mozambique, etc. But I do think that's probably priced in, and I think Transnet is slowly getting its act together. And so I wonder from here whether the upside from Grindrod looks the same, or whether they've had all the easy wins. You know, I'm not very close to it. It has been a good business. Management's done a great job. I would have to look a bit deeper from here to say that I think the prospects remain as strong as they have been as Transnet improves. So I'll leave that at that. And with regard to your question around what was the
Baltic Dry Index.
Oh, the Baltic Dry.
Yes.
You know, that index, I still remember when that was on top of everyone's lips constantly, the Baltic Dry and inflation. And it's up about 170% this year, if I'm not mistaken, the Baltic Dry. And it hasn't moved the needle on inflation at all. So it's almost like, well, first of all, you can't really invest in it. Well, I don't think as a South African you can really invest in it. And I don't think it's really pointing to too much that impacts us directly. It used to be a good bellwether for various economic leading indicators, but I think it's lost that relevance from where I'm sitting. So yeah, I can't add more than that.
Okay. And JP, more upside for Grindrod, or are those easy wins done with? As you know, Grant has mentioned, we are seeing lots of improvement coming out of Transnet.
Yes, I mean, they really cleaned up the balance sheet after they had a bunch of legacy assets and some negative liabilities as well. And they've secured as much as they can for now in the different ports, especially Maputo, where they've got some long-term concessions. So I also agree with Grant that most of the value unlock has happened. There's still some efficiency that will come through, which could lead to strong profit growth as they increase throughput to those ports. But again, because Transnet is sorting themselves out, it means that some freight that has been redirected to Maputo and some other ports might go back to Transnet-operated ports. So that could balance out the strong growth you might have expected from Grindrod. Locomotives is an interesting one. We talk about the privatization or the allowance for private locomotives to use Spoornet freight rail type corridors. That could be an opportunity for them as well. So no, I would sleep well if I had Grindrod in my portfolio, but most of the hard work has been done to unlock the opportunity within Grindrod.
And would you sleep well if you had Supergroup in your portfolio? I was looking at the last financials, earnings were flat, but of course it is streamlining its operations, Grant.
Yeah, I mean, they paid that massive special dividend, divesting from I think the Australian operations. Look, it's a decent management team, but they've got a really difficult business combination across some of the logistics and some of the
Yeah.
auto and motor vehicle space. They really seem to be struggling to get some of the gains that we're seeing in the more pure players like Motus and CMH in the sort of autos and logistics space. And I know they're not exactly the same businesses, but I think they've still got a lot of challenges. And the European exposure doesn't seem to be getting any easier. The UK car market is very difficult. They perhaps don't have the best franchises there. I think Ford cutting out their small vehicles has hurt them. So it's a tough one. It's very cheap. I'll give you that. But I think there's still a bit of a journey there for them to turn that business around, and they're going to need some help from the macros around those European and UK markets. So, yeah, I'd probably look at more. I'd probably look outside of that one at a combination of some of the other holdings, other stocks like Azeda and a super, Motus perhaps,
Yeah.
for combinations of parts of that business.
Let's get your take around that, and maybe we can chat more about the likes of Azeda, a Motus, and even bring in the likes of a CMH.
Yes, so all of those are very cash generative businesses, and some of them have a focus on the retail motor side. Some of them have got significant fleet management operations, like Zeda, for instance. CMH doesn't really have fleet management, but they have the first car rental business. So there are some differences. Between all of the companies we've mentioned, I prefer CMH because they are the most cash generative. They're actually doing a pro rata buyback as we speak because they've got too much cash. It is also the smallest capitalization company of these. So that's one negative. It's more difficult, the liquidity in the share. Zeda will probably just chug along between the Avis rental and the fleet management businesses. And then Motus also really diversifying the business away from pure motor retail.
Yeah.
So they need to continue on that path. And then Supergroup, I agree with Grant. I think there's a lot to fix, but the shares are very cheap. So they're up like 50% in the last month. But they're still trading at a steep discount to tangible NAV. So if the management team, which has delivered in the past, can also deliver on unlocking this opportunity and fixing some of the businesses, especially in Europe and the UK, then there's a big opportunity in Supergroup. So a lot of work to be done, but if they do the work, I see the most upside in Supergroup, while if you don't want any hassles, you can probably stick with CMH.
Sticking with mobility, but looking at the second-hand market, Zeda has exposure to that. We Buy Cars in particular in that space, and we've seen margins under pressure there with the Chinese car makers coming through to the market at a fairly affordable price. Just your thoughts around We Buy Cars as an investment case with these Chinese and Indian vehicles in the market, Grant.
So I think what's happening is people are buying these new cars rather than second-hand cars because the value is there. But so in the short term, there's this margin compression and there's this slower sales of second-hand cars. But what's actually happening is the car park. So the total cars in existence or in the environment in SA is growing. And what that means over time is that the pool of vehicles available for sale is going to increase, and that's good for second-hand cars. So I think over time, that reset is almost a once-off, and then it starts to improve from there. So there's a bit of margin compression, a bit of a slowdown, and then there's a new base from which things will grow. So I'm not negative. I think it's a short-term phenomenon. When I say short-term, it could be 12, 18 months even. But longer term, I think the net effect will be positive.
All right. Let's move over to some other questions. JP, in the mining sector, analysis on Thungela and Kumba. Is it time to buy these shares? We've seen both counters really talking up Transnet and the improvement on that front when it comes to moving their resources.
Yes, and it's important to know which resources. So in the case of Thungela, that's mostly coal. In the case of Kumba, that's mostly iron ore. And in the case of Thungela, they came out with a decent update today, slightly above expectations. They said that their export volumes will probably be slightly more than what they previously thought. So it is looking good relative to the previous expectations. But in general, the seaborne coal market has been depressed after the huge bubble we saw just after the Russian invasion of Ukraine, when there was a squeeze in energy in Europe and they needed to import a lot of coal very quickly. So because of that bubble now being passed and having popped, I don't see a lot of excitement in the coal market. So Thungela is decent, but no great shakes. In the case of Kumba Iron Ore, the iron ore price has been, in my mind, surprisingly strong, even though China has seen a slowdown. Some of that is because India has picked up some of the slack, and also China has moved to higher quality iron ore, and Kumba does have high quality iron ore with a higher Fe content. So Kumba looks okay, but if I think about structurally how the global iron ore market could pan out if you have China slowing down the infrastructure spend, I'm not so optimistic. So I'm not a huge fan of commodities. I probably wouldn't own either of these two, Thungela or Kumba. But if you want some exposure to either coal or iron ore, then they are two decent picks.
And your thoughts around Kumba and Thungela, just considering some of those macroeconomic risks that JP has highlighted on that, on both counters. Are you optimistic, positive on those counters?
Look, Kumba is a good company with good management. It's a high quality miner, but the demand for iron ore doesn't have an obvious catalyst. The Chinese property market remains in the doldrums, and I don't see them renewing the infrastructure commitment of old, which is what drove those previous heady days. So if the whole commodity complex rising tide lifts the boat, it might lift iron ore. In the absence of that, I think Kumba remains a good business, but a cheap business with limited upside, driven only by increasing volumes through the Transnet ports. So no urgency there. I'd rather look for a diversified miner or a copper play, for example. And then Thungela as well, better quality miner in the coal space, is relatively abundant resource, the coal, and I don't really see a catalyst for the price and the demand. But if we see an energy price spike, you could definitely lean into that one. So decent companies, but I don't see an urgency or a positive cycle outlook on the underlying commodities at this stage.
All right, let's get into your stock picks. Grant, where are you seeing opportunity at the moment?
So I'm going for Salesforce, which is the sort of preeminent customer relationship management business. They're prevalent all over the world, including South Africa. The likes of Standard Bank use them, and many other big corporates. And I think the big question mark has been with software businesses is, does AI disrupt them completely? And they all go out of business, and you're seeing that in a lot of price depression across the likes of Salesforce, Adobe, and any number of software stocks. I think they can't all lose. There will be winners and there will be losers. Salesforce, to me, is an incumbent. They have deep domain knowledge and expertise of client-specific data, and I think they are well positioned. They've got good traction in their agent force, which is their AI implementation strategy. Highly cash generative. It's cheapest it's been in many years. It's trading on like 18 times next year's cash flow. So I think they're going to be a winner. I think the risk reward is in your favor. There's good early signs of AI adoption by customers. And so that's my pick. Salesforce, I think they'll be one of the software winners that survive the AI disruption.
All right, let's get your pick then, JP.
Also an offshore stock. It's listed in London, although next year it's going to also have a listing in New York, and that's Wise. Wise operates a foreign exchange remittances platform. So if you want to transfer money overseas or want to accept payments from overseas, it's by far the cheapest way to do that. The banks really charge very high fees when it comes to foreign payments and receipts. And there's this global system between the banks called SWIFT, which is also clunky, takes a long time. So Wise came in and they created this platform with a bunch of local accounts in different countries. And that means that they can offer these foreign exchange transfers very quickly and much more affordably, while still maintaining a decent margin for themselves. So it's been growing very strongly. Adoption has been very strong. They've even now created a platform business where they go to the banks and tell them that maybe the bank should move to using Wise in the background, which over the long term might benefit the banks. And they started now not only doing these remittances, but also having a Wise effectively a bank account or a wallet and a credit card on the back of that, some investment accounts. So they are diversifying away from pure remittances to also making money from wider financial services. And because of that, I think the shares are relatively well priced. So I would buy some wise shares this Christmas.
Like what you did there. JP, Grant, thanks so much for your time. Really appreciated. That's all for Stockwatch today. Thanks to my guests, Grant Nader from Benguela Global Fund Managers and JP Verster from Protea Capital Management. Up next, The Close.